Hello, I'm Peter Vitaliano, Chief Economist for the National Milk Producers Federation. I'm going to be talking to you today about a number of economic issues related to this very strange and interesting year in the dairy industry. I'm going to be focusing primarily on issues relating to milk and dairy product prices and drawing a number of implications from that, as well as looking ahead. There are a number of policy issues in particular that have definitely affected the price outlook. I'm not going to be focusing on them quite so directly. Those are going to be covered by other presentations in this town hall series. The topics I'm going to be covering, as mentioned, is milk and dairy product prices, analysis and outlook, some federal order pricing issues that come from that, looking a bit at milk production trends, and then finishing up with U.S. dairy trade. I want to start by talking about cheese prices because that's been kind of the major story this year. This chart shows the daily cash settlement prices in the Chicago Mercantile Exchange cash cheese markets, starting at the beginning of 2019 and going through October 15th. You can already see on this a rather interesting pattern of change this year. But let me emphasize that by zooming back to the same series, but going back to the beginning of 2015, where we can see a relatively mild pattern of price changes that became very extreme this year. And I want to follow up on several things. First of all, this relatively almost unprecedented gyration of cheese prices this year have given rise to a number of very interesting and in some cases troublesome situations. It's been basically caused by the fact that early in this year, when the pandemic first hit, demand took a big drop. That dropped cheese prices, in this case, all the way down to $1. The government stepped in fairly quickly with some very major dairy product purchases, focusing on cheese. And at the same time, cooperatives sort of collectively took some steps to reduce their production through steps such as maybe some additional culling of cows, the reducing frequency of milking, adjusting feeding programs, drying off cows early, that had a major impact on milk production. I will illustrate all of these things a little bit later, which moved cheese prices, particularly in the cash market, from $1 all the way up to $3 in a very short period of time. It's absolutely unprecedented. Then we took a major drop after that when that initial round of purchases, the effects wore off a little bit. We started having a second wave of the coronavirus infections, and it affected food service demand again. And then has subsequently taken another increase driven by a number of factors, but particularly the sort of a second round of major USDA dairy product purchases, particularly focusing on cheese. So it's been very much a roller coaster. I want to take a little bit of a detour here and talk about the difference between the block and barrel cheese prices in that series I just showed. This one starts in 2017. You'll notice that series itself, just the difference between those two, has also become much more unstable and volatile, reaching $1 pound in fairly recently. Again, this is the difference between the daily cash cheese price for block cheese and for barrel cheese. That relationship is normally basically a difference of 3 cents. Which is basically the difference in packaging costs between blocks and barrels. Obviously, a number of other factors are affecting that relationship. But let me build on toward my first step toward building from talking about dairy product prices, talking about milk prices, which is what really the main issue of interest is. And this shows something very similar, but it is not the daily cash market prices, but weekly National Dairy Product Sales Report prices for cheese. Again, both block cheese and barrel cheese. These are survey prices, not cash market prices. These are prices collected for cheddar cheese by USDA's mandatory dairy product price survey program. And these are the building blocks that go into the federal order formulas. These prices are collected weekly, and you can see that pattern. And it vaguely resembles, or reasonably closely resembles, with a bit of a lag, the pattern that we saw in the daily cash cheese market prices. I mentioned that the normal relationship between the price of cheese in both block and barrel forms is 3 cents. I'll return to that shortly. And if you add that 3 cents onto the weekly survey prices of barrel cheese, you'll see that that series still stays well below, on average, the price of block cheese. The block and barrel cheese prices have been diverging a lot more than that 3 cents lately, and that's caused a number of issues that I'll refer to a little bit later. The weekly survey prices for cheese are weighted together, blocks and barrels, with the barrel cheese price raised just 3 cents to technically equate it to block prices. That those weighted average prices are collected together on a monthly basis, either 4 weeks or 5 weeks of prices, depending on the number of weeks in a month, and are put together for the National Dairy Product Sales Report price of cheddar cheese, which is a weighted average, again, of barrels and block cheese. These are the prices that are directly plugged into the federal order pricing formulas for the Class 3 price for milk that is used to produce cheddar cheese and dry whey. And this is the series that currently has basically a futures market price so that it can be forecast. And again, you can see this pattern. This goes back to 2012, where lately you've had a much more volatile relationship of cheese prices than typically has been the case. That most recent low point in 2020 is the lowest monthly cheese price since 2009, and that high one just after it is the highest we've ever recorded. In between that and the 2013-2014 period, which was another relative high period, cheese prices were relatively depressed, and this correlates. I'm looking ahead now. Correlates with the fact that milk prices have been relatively lackluster during that period, 2015 to roughly the first half of 2019. So let me kind of, in a sense, cut to the chase here to motivate why I'm going to go through a little more detail on dairy product prices. And I'm going to do that by trying to explain milk pricing in 20 words. Milk pricing is legendarily complicated. I'm going to try to do it in 20 words. Well, okay, 33 words. And here it is. Due to their key role in the federal milk marketing order pricing formulas, the prices of butter, cheddar cheese, non-fat dry milk, and dry whey mostly determine U.S. average milk prices each month. Now, you all know that these product prices have something to do with milk prices. What I'm saying here is, in a sense, they have everything to do with milk prices. Let me show you. This is a track of the monthly milk prices called the all milk price, reported by USDA since 2000, which was the time that the current federal order pricing formulas were introduced into the federal order system. This is a track of what I call the 4-product fixed formula that is just a simple arithmetic formula of those four product prices, those four monthly product prices, with fairly fixed factors this whole period, that kind of tries to mimic a national blend price for the federal order price classes that basically are pooled in all of the federal orders. It's a very simple formula. These factors don't change very much. And when you superimpose those two series, you see that that simple four product fixed formula does a fairly good job of predicting, of tracking the actual prices. There's a few changes, particularly in the high points in recent years. I do adjust these further with a basis, a monthly basis that brings these even closer together. But for all practical purposes, if you just plug in those four product prices, you can calculate a pretty close equivalent to what is going to be paid to dairy farmers. So with that orientation, with that hopefully highlighted interest in what's happening to product prices, let's go back and cover the other three, non-fat dry milk, skim milk prices, again going back to 2012. You see the pattern here, a relatively high point in 2014, followed by a major drop and a very slow recovery. And then the dotted line off to the right is a forecast through next March, showing some recovery. What happens here is, I will show you in this next slide. I'm going to superimpose on these domestic prices, international prices, particularly prices reported for in Oceania, that's New Zealand and Australia, major pricing points in world markets. And you can see there's a very close correlation between domestic and international prices. The international price series was affected by the fact that up until around 2015, the European Union, major dairy producer and exporter, had been restricting its milk production through production quotas that were then taken off around 2015, and they expanded milk production, particularly into the export market. In the case of non-fat dry milk, that resulted in a major depression of world prices, which fed directly into international prices, of domestic prices, because those two are very closely correlated. That excess world supply lasted until roughly halfway between 2019 last year. And the reason why these are so closely correlated is this is a chart that basically shows the percentage month by month of U.S. non-fat dry milk, skim milk powder production that is exported. And if you run a trend line through that, you'll see that we've gone from, in 2012, when we start here, from below 50% of our production that's exported to close to 70% now. Dry whey prices, relatively similar story. Relatively high prices in up until about 2015. This was driven particularly by major dry whey purchases by China, which dropped off. And since then, whey prices in this country have never fully recovered. Superimposing international prices, in this case, Northern European prices, you'll see again, those are fairly closely correlated because a fairly significant proportion of US production is exported. Basically, somewhere between 55 and maybe 45% of our dry whey is exported. That, again, as with non-fat dry milk, it makes the domestic and world prices fairly closely correlated on a price basis. Let's move to butter. Again, this is the U.S. domestic prices for butter with a little bit of a forecast there on the right side. This has been different than cheese, non-fat dry milk, and dry whey. Those other three basically were relatively low in terms of prices from 2015, 2019. Almost the opposite happened with butter. This is a period in which U.S. consumers came back to consuming dietary fats in a fairly significant way after the research cautioning against fat consumption in human diets and its impact on cardiovascular health, got reevaluated. Demand in the domestic market for not just butter, but for milk fat in a lot of products, whole milk consumption reversed itself and started growing again. Higher fat yogurts and cheeses were consumed. And we went through a period in which the price of butter was consistently kept up well above $2, and for a period between 220 and 240. That came to an end into the second half of 2019, and then took a further plunge this spring as a result of the demand impacts of the coronavirus, followed by a modest recovery. But the futures indicate that we're not going to be getting back anywhere near to that 220, 240 price range anytime soon. Superimposing again, as we've done with the previous ones, the Oceania prices, you'll see that there's some correlation here, but there's been there are periods in which domestic and world prices for butter can diverge very significantly. And in particular, the world market didn't really share that same significant drop in April and May that the domestic market experienced for butter. And in terms of the export percentage of production that I've showed you for the other products, butter is very different. It's a little hard to draw a trend line, but basically, if you follow that, we're down in recent years to exporting not much more than between 2 and 4% of our production in terms of our exports. And then finally, I showed you the domestic track for cheese. This basically just completes that by adding in the world price for cheese. Again, you'll see some correlation, but not nearly as close as in the dry skim milk products, dry whey and non-fat dry milk. And in particular, the very significant gyrations of domestic prices this year have not really been tracked very closely by the world market. And again, the export situation, U.S. exports as a percentage of production for cheese, much more modest than for the dry products. Again, a trend line will show us going from 5 to maybe up around 7%. If you think back about, put together what I've said about the fact those 4 product prices can largely make up the price of milk. The fact that cheese, non-fat dry milk, skim milk powder, and dry whey prices were relatively depressed from 2015, 2019, and the butter was just the opposite. This chart shows an implication of that, which is basically it's my reconstruction of an estimate of the monthly proportion of the total milk price paid, as reported by the USDA's all milk price, that is contributed just by the butterfat portion. And you'll see that historically, up until 2000 through 2015, that had averaged about 40%. Varying maybe up a little bit above 50% occasionally. That rose suddenly during this period when cheese prices or butter prices increased. The other 3 product prices were depressed. That went up almost 20%, average for a period of time, about 60%. It's dropped down again recently as the prices of those other products have recovered somewhat and butter prices have come down. So there was a period there of a couple of years in which dairy farmers were making the majority of their milk checks basically just from the butterfat component. And I'll show you an implication of that shortly. Another implication of the instability of cheese prices recently, the price of cheese is a major driver of the Class 3 price in federal orders. And this chart shows the monthly Class 3, Class 4 prices and kind of compares them with the monthly Class 1 prices starting in 2017. And you'll see normally through a good portion of this period up until this year, The Class 1 price stayed well above the Class 3 and the Class 4 prices, but because of that sudden increase, the big drop in Class 3 and Class 4, followed by the very, very significant recovery of Class 3 prices, the Class 3 price rose well ahead of the Class 1 price and certainly well above the Class 4 price. And I'm not showing the Class 2 price on here. It stays pretty close to the Class 4 price. And we had a period when several months, and may have some in the future, when Class 3 significantly exceeds all the other classes. And that, as you well know, gives rise to the situation that we've been much talked about of negative producer price differentials. This happens basically when one of the manufacturing prices, in this case Class 3, has significantly exceeded the price of the other classes. And you'll see them here. Class 3 price, Class 4, Class 2, Class 1 mover, and the estimated average Class 1 price in the country. And you'll see in June, July, and August, Class 3 was well ahead of those others, and that gave us a negative PPD. And the negative PPD is basically an arithmetical calculation that results from the federal orders that incorporate component pricing. All milk that is pooled in such orders is paid the Class 3 price for components. And when the Class 3 price and the component prices from that are well above the others, paying for all milk pooled at the Class 3 price basically involves more money than is in the pool, which is contributed by those other prices times the volume of milk that is pooled under those classes. And when that happens, in order to keep that pool balanced, you have to take away the producer price differential from the Class 3 component payments. That gives the negative PPD. Now, that's just an arithmetical calculation that looks ugly on a milk check, but what really causes issues in negative PPD situations is the depooling of that higher class price milk, in this case, Class 3, because pooling is only required in federal orders for Class 1. That's how they've been set up. Looking ahead, this chart has some forecasts for the next several months. These are not forecasts of the PPDs, but they're kind of indicators. It would look at first glance like September with Class 3 well below Class 1. We may not have negative PPDs, but that's not been the case. You'll notice Class 3, Class 4, and Class 2 are still quite a bit below Class 3 in that month. October, again, comparing the Class 3 forecast with the other classes, looks very definitely like we'll have negative PPDs again, and probably that's going to be the case through the end of this year. There's another factor is that I want to talk about with federal orders, and that's the change in the Class 1 skim milk price mover. From the beginning of the current federal order pricing formulas in January 2000 up until April of 2019, the Class 1 skim milk price mover was calculated as the higher of the advanced Class 3 and Class 4 skim milk pricing factors. That was changed by mutual agreement between National Milk Producers Federation and the International Dairy Foods Association, representing the processors, to the average of the Class 3 and Class 4 skim milk pricing factors plus 74 cents a hundredweight, which reflected the average difference between the average of those Class 3 and Class 4 skim milk pricing factors and the higher of. It was done to basically facilitate hedging and price risk management for producers and processors of Class 1. When the Class 3 and Class 4 skim milk pricing factors are less than $1.48 apart, the current mover, the average of plus 74 cents, will be higher than the higher of. When those two differ by more than $1.48, that the current one will be lower. Under the current circumstances, which you recall that previous chart, Class 3 and the Class 4 prices have deviated very significantly, resulting in very significant differences in the previous and the current Class 1 mover, leading to significant losses. In particular, from May through May 2019, when the mover was changed, to this past June, producers gained an average of a total of about $39 million or 2 cents a hundredweight on all milk pooled federal orders due to the change. Normally, the current mover is somewhat higher than the previous higher up mover, but that has reversed itself. And from July through October, the estimated loss is going to be almost 10 times that, or about $1.07 per hundredweight on all milk pool due to that change. National Milk Producers Federation is convening its Economic Policy Committee to examine alternatives, modifications for that to prevent this sort of thing from happening in the future. So with that, I'm going to change to looking at milk production and then ending up with looking a little bit at international trade, dairy trade. Now I want to go back here for about 20 years and show you a chart that shows month by month the annual change of the number of U.S. milk cows. Each bar on this chart represents the difference between the national dairy herd milking cows that month compared to the number that same month a year earlier. If that bar is above that zero line, it means the herd was growing that year, that month from a year ago. If it's below that zero line, it means that the herd was smaller than it had been previously. And you'll notice that these changes occur in very definite and identifiable cycles, each one of which is maybe between, a little, generally more than a year, off mostly less than 2 years long. They have this pretty well developed bell shaped to them, whether they're increases or decreases. And up until about 2005, we basically had a mix of increases and decreases. This was because the total demand for dairy was not growing as fast as production per cow, and we needed to lose about 0.5% of the national dairy herd each year to stay in balance, and market prices made that happen. From 2005 through 2009, we had two major cycles of expansion, and that was basically due, as I'll show you a little later, to the fact that we were significantly expanding our dairy exports and needed more milk and therefore needed more cows. 2009, during that recession, we lost a major amount of our exports and had the last of the CWT herd retirement programs, and we had a very major contraction of the dairy herd, followed by another expansion cycle. I like to think that between 2013 and 2014, we would have had a down cycle, but prices were so strong that year, primarily due to the fact that China was importing dairy products in unusually large quantities because of a shortfall in their transition in their entire milk production system. And that as a result, what would have been a contraction during those years was kind of the dairy herd was treading water, let's say, during that period. Starting in 2015, when prices dropped and were relatively lackluster, 2015 all the way through parts of 2019, when we should have had a herd contraction, we had two expansion cycles. This goes back to just those last two cycles. The second of those two expansion cycles in the 2015-2018 period, we finally had a contraction after several years of depressed prices. But that contraction cycle came to a fairly quick end, and we started this year with the most probably energetic expansion, national dairy herd expansion cycle we've ever seen. You'd have to go back, I think, to 2003 on that earlier chart to see one in which, in the first 3 months of an expansion cycle, the increase was that large. So we entered into this coronavirus episode with a full head of steam on expansion of the national dairy herd, which exacerbated the price problems that occurred subsequently. As a result of a number of factors going up through the most recent data, that expansion cycle, luckily, has been blunted, to say the least. Part of this was due to the concerted actions of dairy cooperatives and their base excess plans and producers reducing their milk production, culling some cows, but not fully. The herd was still expanding, but the herd expansion has been kept under reasonable control, and we did not have a runaway expansion cycle. Let me switch now to looking at milk production itself during this same period. This is a similar chart, only it shows the monthly percentage increases in milk production each month over production a year earlier that same month. And you can see this sort of tracks the second of those herd expansion cycles, when milk production was up by almost 3% at a peak. Very slowly, that rate of expansion, monthly expansion, had been drawn down, and after more than 2 years, we actually dropped milk production for a few months. Very quickly, though, as prices started recovering in the second half of 2019, we had a very quick recovery in milk production to the point where we sort of shot back up to almost as high an increase over the previous year as we had at the height of that last cycle in late 2016. This time around, in just 2 months, from March to May, we dropped that rate of growth from almost 3% down to a negative in just 2 months through those concerted actions by cooperatives and dairy farmers, accomplished that same reduction in milk production growth that it took just milk prices by themselves over 2 years to accomplish. Now, when those measures were taken off, you can see more recently, milk production has bounced back fairly quickly. Now, let me superimpose on that chart of the annual rate of growth month by month of liquid milk production, growth in milk solids production, because it is milk solids that really represents the supply of milk ingredients that interacts in the marketplace with the demand for milk and dairy products. Because most dairy products are of standardized composition. Recall that chart earlier where I showed the proportion of the milk check, average milk check, due to the milk fat portion alone, and how that bounced up from around 40% to close to around 60% for several years. Dairy farmers reacted to that. They were making some during a time when milk prices were depressed, but their milk fat prices were not. Farmers, not surprisingly, took steps to increase the composition of their milk fat composition of their milk, and we gave rise to the first major increase in decades in the average composition of milk, to the point where that increase was so strong that the year-over-year rate of increase in milk solids production rose notably above the same rate of growth for just liquid milk itself. That when butter prices dropped in second half of 2019, and the other products started recovering somewhat, you'll notice that that divergence in the rate of growth of liquid milk production and milk solids production came to an end for a period of time. But lately, the latest numbers show that that milk solids production is again exceeding in growth rate that of liquid milk production. Now let me switch on my final topic here to U.S. dairy trade. Many of you have seen this chart. that I developed some years ago that shows the estimated percentage of U.S. milk solids production that is exported. That's the red line, and an equivalent percentage of measuring essentially how much milk solids we import in all the different dairy products that are imported, expressed as a percentage again of U.S. milk solids production. You can see that has been diverging significantly. They were very close together for the first third of this chart. Then during that period when again the European Union was pulling back its milk production or halting its milk production growth through production quotas to get its dairy surplus under control, surplus that it largely exported. The U.S. was able to grow into that as a result of that restraint by the European Union. But when the EU took its production quotas off 2015, and furthermore when it was its dairy exports to Russia were embargoed as a result of a political disagreement over annexation of the Crimea and actions in the Ukraine. Our export growth came to a sort of stalled out for a number of years. It's been growing again recently. That's a good sign. If we decompose this, we see strong evidence of what I call the U.S. structural surplus of skim milk solids. Butterfat and skim milk solids are produced in relatively constant proportion, particularly fat and protein. And our domestic market demand is much stronger for milk fat than it is for skim solids. In 2019, we exported roughly 4%. Total commercial use of milk fat in 2019 was basically only consisted of only about 4% of exports. The other 96 was domestic market growth, use. That was very different when you express that same relationship on a skim solids basis, where we've exported total commercial use of skim solids in 2019. Almost 19% of that was exports, and just a little over 80% was domestic. This so-called structural surplus has been with us for many years. Back in the days of the price support program, we basically purchased and stored that surplus in the form of non-fat dry milk. Now we're exporting it commercially at higher prices and are much better off. But that means that we are very dependent on the export market for our skim solids, much less so for our fat. And then let me conclude here by just looking ahead. The futures are indicating that we're going to have a second run up in prices, driven again largely by this second wave of government purchases. But after that, milk prices are forecast through the first half of next year to sort of drop down to averaging somewhere around $18 per hundredweight. That's a little bit less than milk prices averaged during 2019, but ahead of where they averaged from 2015 to 2018. And then lastly, the dairy margin coverage program forecast of what the margins are going to look like this year. Going into this year, it looked like we were not going to have any payments under that program, but then the coronavirus pandemic changed that completely. And you saw we had, in particular, 2 months of very significant payments, April, May. It looks like we're going to have a dip down below that maximum $9.50 coverage level in the month of September. But then looking at a recovery for the last several months of the year. But the current forecast is we're going to be dropping down again below that 950 coverage level. which would indicate we've just started the sign up for the 2021 Dairy Margin Coverage Program. It's as we saw this year, when we did not expect that program was going to make payments, it made major payments. It's an insurance program. You really can't trust what the forecasts are. We urge all producers to sign up for dairy margin coverage if you've not already done so in advance for dairy margin coverage at the 950 level for your first 5 million pounds of milk production. And with that, thank you very much for your kind attention.